The US Treasury Department held an auction of 3-month bonds worth $57 billion on Monday, April 17. The auction resulted in a winning yield of 5.1%, marking the highest level since January 2021. This development highlights the impact of the ongoing debt ceiling crisis on the bond market. It's worth noting that the maturity date of the bonds falls within the period when the market expects the U.S. federal government to face a possible shutdown and default due to the debt ceiling. The auction is another indication of the market's growing concern over the debt ceiling crisis. Typically, investors avoid purchasing U.S. bonds that mature around the time when the Treasury is expected to exhaust its financing options. In other news, U.S. Treasury Secretary Janet Yellen revealed on April 15 that there are legal limitations on how to handle frozen Russian assets. Speaking on the issue of Russian sanctions, Yellen noted that the U.S. and the West have frozen more than $300 billion in foreign currency assets held by the Russian central bank. She further explained that a significant portion of these assets was previously deposited in the New York Federal Reserve Bank. Yellen acknowledged that confiscating assets of other countries is illegal and stated that she is aware of the potential consequences of sanctions for the U.S. and its partners. Yellen's concerns about the illegality of confiscating foreign assets reflect the U.S. Treasury Department's efforts to make its financial restrictions more persuasive through new legislation in the U.S. Congress. It's worth noting that since World War I, the U.S. has confiscated the assets of several countries' central banks and related enterprises and individuals, such as Germany, Japan, Iraq, Libya, Afghanistan, and Venezuela. In the years leading up to the 1920s, the U.S. confiscated about $500 million of private property belonging to other countries in the U.S. This amount was equivalent to, or even higher than, the federal income of the U.S. at that time. Furthermore, the U.S. directly confiscated over 140 tons of gold reserves from the Libyan central bank. The German central bank discovered that the gold bars it had transferred from its previous 1,500 tons stored in the Federal Reserve's gold vaults from 2012 to 2017 were different in both individual volume and shape from the gold stored in the Federal Reserve's vaults in the mid-1940s. Analysis suggests that the Federal Reserve may have already misappropriated Germany's previously stored gold, and when the German central bank first requested the return of its gold, it had to use other depositors' gold to fulfill the request. Former Federal Reserve Chairman Greenspan testified to the U.S. Congress in 1998, indicating that the Federal Reserve is always ready to increase the quantity of gold leased to foreign countries to obtain commercial profits. Over the years, the most frequently heard word in the U.S. economy has been sanctions, as the U.S. Treasury Department continues to impose financial restrictions on nearly 40 countries worldwide, affecting almost half of the world's population. From 2000 to 2021, U.S. foreign sanctions increased by 933%, with over 3,900 sanctions implemented during the Trump administration alone, averaging 3 sanctions per day. In particular, the U.S. continues to impose financial restrictions on several oil-producing countries highly dependent on oil exports, such as Iran, causing these countries' economies and currencies to fall into a crisis due to a shortage of U.S. dollars. However, despite these efforts, the U.S. hegemony has accelerated the global process of de-dollarization and induced bond holdings. More and more countries have realized that the U.S. dollar and U.S. government bonds are unreliable. As of April 16, at least 86 countries have started de-dollarization using one or more methods. On the other hand, the U.S. continues to face challenges in maintaining its economic and financial dominance. The rise of China and other emerging economies, along with the increasing trend of de-dollarization, pose significant threats to the U.S. dollar's status as the world's reserve currency. In addition, the growing debt crisis and political instability within the country further undermine the confidence in the U.S. economy. Despite these challenges, the U.S. government seems to be reluctant to change its approach to international relations and economic policies. Instead of seeking cooperation and mutual benefit with other countries, it continues to rely on unilateral actions and coercion to advance its interests. The use of financial sanctions and other forms of economic warfare has become a defining feature of U.S. foreign policy, often resulting in negative consequences for both the targeted countries and the global economy as a whole. In conclusion, the U.S. Treasury auction of 3-month bonds at the highest yield since January 2021 highlights the impact of the debt ceiling crisis on the bond market. Meanwhile, U.S. Treasury Secretary Janet Yellen's concerns about the legality of confiscating foreign assets reflect the U.S. Treasury Department's attempt to make its financial restrictions more persuasive through new legislation in the U.S. Congress. However, the U.S. reliance on financial sanctions and other forms of economic warfare to advance its interests has caused increasing concerns among investors and other countries, leading to the global trend of de-dollarization and the erosion of the U.S. dollar's status as the world's reserve currency. Thanks for watching. If you found this video helpful, please consider subscribing for more content. Take care.